A new report from RBC shows that young Canadians have built wealth faster than any other age group since 2020, but their income growth tells a very different story. To help break this down for us, we're joined by Rachel Battaglia, economist at the Royal Bank of Canada. Rachel, thank you very much for joining us.
Thanks for having me.
It's surprising to hear that young Canadians are socking money away. We've talked about how they're struggling, but yet they're finding ways to make some money right now. How's that working?
Well, we've been looking a lot at the health of the Canadian consumer, in part because this has been one of the strongholds for the Canadian economy amid all of this trade turbulence. But you're right, it begs the question of, is this being felt uniformly? And if we look at young Canadians in particular, those households where the primary income earner is under 35, we are seeing some signs of struggling. If we look at incomes in particular since the first quarter of 2020, we'll see that incomes have fallen behind the national average. And if we seasonally adjust that data on a real basis, we'll see that those incomes have actually fallen below the rate of inflation as well, which suggests that on a real basis, incomes are declining for that group. Now, that's a pretty stark contrast from what we're seeing on the wealth side, which is wealth accumulation has grown faster for that group than any other age cohort. Again, that's since the first quarter of 2020 until the second quarter of 2025.
Gavin, you have a question for Rachel.
Yes, Rachel. So people have been talking about the K-shaped recovery, where those people who have assets and have benefited from the stock markets going up are doing pretty well. But those people who are actually living paycheck to paycheck, and obviously the majority of those would probably be under 35 because they're just starting out, they haven't had a chance to accumulate, are not doing so well. This research would seem to support that, I imagine.
Well, it does in part. Incomes and wealth measure fundamentally different things, right? Incomes measure more so a flow of money, whereas wealth is more so looking at that stock. And to build wealth, you generally need to convert that flow of money into assets. Now, that's a process that can be very easily disrupted by increased spending, be it on taxes or due to inflation or just other spending pressures. And it can also be disrupted by slower growing income gains. Now, for younger households, this is exactly what we're seeing, right? On a real basis, those income gains are failing to keep pace with inflation. However, we have to remember that we've seen pretty impressive home price appreciation over the last 4 years or so. Home prices have come down recently. However, they're still sitting about 25% above where they were at the end of 2019 and beginning of 2020. We've also seen really impressive equity market performance and pretty high levels of government transfers, particularly during the pandemic when we saw that CERB-style disbursement. Now, those are things that disproportionately benefited the net wealth position of those younger households, given on average they tend to hold on to lower reserves. In addition to that, I will also point out that we've seen a pretty juicy uptick in the financial asset holdings of those groups. Now, that includes things like cash deposits, which brings into question the role that intergenerational wealth transfers are playing in all this as well. Because if we look at income statistics and we look at the labor market, we're just not seeing that compensation growth is really supporting that.
So is that what we're starting to see? Is it inheritance and parents sending them money? And where's most of their wealth coming from? Is it coming from the market, or is it from the markets, or is it coming from buying a home and watching their home appreciate?
Well, a little bit of both. Financial assets is a big cause for that uptick, but so is net real estate holdings. On the liability side, which is equally as important too, I'll point out, we've seen younger households cut their mortgage exposure too faster than other age groups. That could be for a couple of reasons. One being that younger households who originated or renewed a mortgage during those ultra low interest rate period of 2020 and 2021, they benefited from those low borrowing costs and were able to pay down that debt faster. At the same time, though, since about 2022, I'll say, we've seen more younger Canadians postpone or avoid home ownership altogether. And that also impacts the liability side of things as well.
All right, we're almost out of time, but Gavin, we'll give you the last question.
So would it be fair to say then, Rachel, that the under 35s are doing okay generally, but there are some cause for concern with the income falling behind the rate of inflation?
Well, it's the sustainability that is where we are most concerned. This is not a very good foundation for them to continue accumulating wealth or to even maintain the wealth that they have built recently. Without incomes, you're relying more heavily on factors that are further from your control. Things like market timing or government transfers or the ability or willingness of family members to transfer that wealth over to you.
Okay, we're going to have to wrap it up there, but Rachel, thank you very much for joining us today.
Thanks for having me.
Rachel Battaglia is an economist at the Royal Bank of Canada.